Okay, this is part 3 of chapter 10 practice. We had just a couple of problems left. So as we go into this next one, number 8, we are looking at disposing of a machine. So we see here that it says Diaz Company owns a machine that costs $250,000 and has accumulated depreciation of $182,000. They want us to prepare the entry to record the disposal of the machine on January 1st for each separate situation they have listed in numbers 1 through 4. So what we have to factor in is that we had a cost of $250,000 minus accumulated depreciation of $182,000. So that leaves us with a book value of $68,000. So let's pull up the calculator to show that calculation. We have $250,000 minus $182,000. So that leaves us with a book value of $68,000. So if we're looking at this, we have to think about each of these different scenarios. So the first one, it says that the machine needed extensive repairs and it was not worth repairing. So Diaz disposed of the machine, receiving nothing in return. So basically, that $68,000 book value, we're just chunking it. We're getting rid of it. So this one, we have to record the disposal of the machine with nothing in return. So what that means is that $68,000 is now a loss that we had. So what we're doing is we're removing the machine and the accumulated depreciation from the books, and that's going to take care of the cost minus depreciation. But we have to figure out, what do we do with that other $68,000? So that's recorded as a loss. So we're going to see loss on the disposal of a machine. A loss is going to be debited, a gain is going to be credited. So here, because we didn't receive any money, we have a $68,000 loss because that book value was $68,000 and we're getting nothing in return for it. Then we're going to remove the accumulated depreciation for the machine from our books. The accumulated depreciation was $182,000. It has a credit balance, so to close it, we're going to debit $182,000. And then we're going to credit the machine. The machine had a debit balance of $250,000. So we're going to credit it $250,000. And that's going to remove the machine from the books, remove the accumulated depreciation, and it's going to take care of that $68,000 book value that we had and show it as a loss. All right, next situation, same scenario, but this time, instead of just getting rid of it, now we're going to sell the machine and we're getting $35,000 cash. So anytime we're getting cash, we're debiting cash, and we're getting $35,000. So we have to figure out now, okay, well, we had the cost minus the accumulated depreciation. That gave us $68,000. Well, is that $35,000 going to cover that amount? It's not. So this is where we have to go back, and if you remember, we had a PowerPoint slide in chapter 10. That's what I'm showing you here, where it showed you the disposal of the plant assets. Normally, the first thing we have to do is make sure that the depreciation is up to date before you dispose of it. And then once you dispose it, you're going to do journal entries. You're going to be removing the asset cost by crediting the asset. You're going to remove the accumulated depreciation by debiting that account. And then if you have a gain, you're going to credit. If you have a loss, you're going to debit. If you're getting cash, you're going to debit. If you're paying cash, you're going to credit. So that's the first part. The other part we have to look at is how do we determine whether it's a gain or a loss? Well, in our PowerPoint, we saw that if the cash was greater than book value, we record it as a gain. If cash is less than book value, we record it as a loss. If cash is equal to book value, then there's no gain or loss. So we would just recognize the transaction with no gain or loss. So let's go back to this scenario now. So our cash is $35,000. Our book value is $68,000. So our cash is less than book value. So we are still going to record a loss. So we have cash that we're getting of $35,000. We still have a loss, but this time it's not on the disposal, it's on the sale of a machine. So how much is that loss? Well, we can calculate it here. We have $68,000 minus the $35,000 we're getting in cash, and that gives us a $33,000 loss. That's what we're going to record for the loss on the sale of a machine. We're still going to remove that accumulated depreciation for the machine of $182,000. And we're still going to remove the machine itself for the $250,000. Our debits and credits equal $250,000, so we know that we can move on. So the first one, we just got rid of it. We didn't sell it for any money. We just disposed of it. This one, we're selling it for $35,000. And the next scenario, we're selling it for $68,000. So then we can go back to this PowerPoint slide. Cash book value is $68,000. Cash is $68,000. So there's no gain or loss. So then we're still going to just be removing the asset from the books and recognizing the cash we're receiving. So we're getting cash of $68,000. We are removing that accumulated depreciation for $182,000, and we're crediting the machine for the $250,000. Our debits and credits both equal $250,000, so we're okay. Our last one, this time, we're getting $80,000 cash. So if we go back to our scenario, our book value is $68,000. We're getting cash of $80,000. So cash is greater than book value. So this time we're going to record a gain, which is a credit. So we're still going to recognize our cash that's being received. We are getting $80,000 in cash. We are removing accumulated depreciation for the machine for $182,000. We are removing the machine for $250,000. And then we can recognize that gain on the sale of the machine. The gain, that's where we have to calculate next. So we know we have a book value of $68,000. We are getting $80,000. So we have a $12,000 gain that we must factor in. So the $12,000 is going to make both of these numbers equal $262,000. So that's our number 8. And this is recognizing the disposal or the sale of an asset and removing it from the books when we get rid of it. Let's look at number 9. All right, this one is for depletion. So it says Montana Mining pays $3,721,000 for an ore deposit containing 1,525,000 tons. The company installs machinery in the mine costing $213,500, which will be abandoned when the ore is completely mined. Montana mines and sells 166,200 tons of ore during the year. They want us to prepare the year-end entries to record both the ore deposit depletion and the mining machinery depreciation. So mining machinery depreciation should be in proportion to the mine's depletion. So we'll look at how we do that. All right, so for the depletion, remember, we are looking at using the same concept we do for units of production when we're using depletion, because it depends on how much we pull out of that mine. So we start with a mine first, and it says we have $3,721,000. And we expect it to be worth 1,525,000 tons. So that's going to be $244 per ton that we are going to depreciate. Well, it tells us in the problem that Montana mines and sells 166,200 tons of ore during the year. So we're going to multiply that 244 times 166,200, and we're going to be depleting $405,528. So $405,528. The entry, just like for depreciation, we debited depreciation expense and we credited accumulated depreciation. For depletion, it's the same concept, just different wording. So we're using depletion expense and accumulated depletion for $405,528. All right, that takes care of our first one. This is the depletion expense for the ore mine. Next, we have to look at the machinery. Remember, it's a plant asset, but we're still going to use units of production because it says base it off of how much was used. So we're going to use units of production. So we have a cost of $213,500. It tells us that it will be abandoned, so it does not have a salvage value. And we are going to divide it by 1,525,000 units. So it's 14 cents per ton. So again, it's times 166,200 tons. So we're going to be depleting or depreciating this plant asset machinery for 23,268. So 23,268, and we're going to be debiting the depreciation expense for machinery and crediting accumulated depreciation for machinery. All right, here's the check my work so you can take a look at the entries. That is an example of depletion. Next, we are going to look at an example of amortization, which is what we do for our intangible assets. The things we can't physically touch, like a copyright or a trademark, leasehold improvements, those kind of things. So this one says Milano Gallery purchases the copyright on a painting for $418,000 on January 1st. The copyright is good for 10 more years. The company plans to sell prints for 11 years. The thing we have to remember with intangibles is you can only depreciate or amortize over the life that you have left in that protection. So in a copyright, it says we have 10 more years left. So that's all that we can use. We can't do any higher. So here we had $418,000 as our cost. There is no salvage, and you'll see that commonly in amortization, and it's going to be for 10 years. So it's going to be $41,800 per year that we can amortize. So the first thing it says is to record the purchase of the copyright on a painting, and we paid $418,000 cash for this purchase of the copyright. So the copyright is an asset. It's an intangible asset. So that's what we're going to be recording as our asset for $418,000. We paid cash for it, so $418,000. The next one is where we're recording our amortization, and just like we saw for depreciation and depletion, it's the same wording. So we're going to use amortization expense, and it was that $41,800 that we calculated, and then accumulated amortization for $41,800. And then we can see the both entries for that one. So that's an example of amortization for when we have intangible assets. All right, we have one more problem, and this deals with our ratio for Chapter 10, and it's looking for the total asset turnover. So it says here that Lock Company reports net sales of $5,856,480 for year 2 and $8,679,690 for year 3. End of year balances for total assets are year 1, $1,686,000, year 2, $1,800,000, and year 3, $1,982,000. So if we look back and get our formula for the total asset turnover, you can see that they want us to do both years 2 and 3. So we need to use net sales, and we are dividing that by the average total assets. So average, that's why they give us more information for total assets so that we can do that average. So here we're going to start with net sales. We're going to plug in the first number for year 2, 5,856,480. For year 3, we had 8,679,690. And then for average total assets, we have to actually do the averages. So what we're doing is we're adding years 1 and 2 and dividing by 2. Year 1 was 1,686,000. Year 2 was 1,800,000. And then we're going to divide them by 2. And that's going to give us our average total assets for year 2 of 1,743,000. That's going to give us a total asset turnover of 3.36. Then we're going to do the same thing for years 2 and 3 to get the average for them. We have 1,800,000 plus 1,982,000 divided by 2, and we get 1,891,000. And that's going to give us a ratio of 4.59. So we can see that from year 2 to year 3, total asset turnover increased. Well, that's what we want to see. We want to see that number higher. So our last question here says Lock's competitor has a total asset turnover of 3.0 during year 3. Is Lock performing better or worse than his competitor on the basis of the total asset turnover? So for year 3, we have 4.59. They have a 3. So we are doing better. Okay, this concludes our Chapter 10 practice. Please make sure you have a thorough understanding. If you have any questions, please let me know.